This is your LMAX exchange technical update for Friday, June 2nd, 2017. Euro dollar. So the euro continues to trade within a firm uptrend in 2017, with the market now poised for fresh upside towards the next key objective, which comes in by the August 2016 high at 113.67. The market has stalled out a bit on a short-term basis, but we would need to see a break back below some recent support around 111.10 to take the immediate pressure off the top side and suggest that the market wants to see a bit more of a correction before it heads higher. Ultimately, while the market holds above a previous higher low at 108.40, the structure remains constructive, and we should expect a test up towards that next key objective at 13.67 in the form of that August 2016 high. Sterling dollar. Cable has been doing a very good job of consolidating above a previous resistance zone at 127.75, and ultimately now the focus has shifted to the top side, with the market expected to trade up towards a measured move extension at 135 in the weeks ahead. But there is still room for some form of a corrective pullback, and that corrective pullback could extend into the 125 area before the market looks to put in a higher low and resumes the upside momentum towards 135. Ultimately, though, while we hold above 23.60, the market should remain in this constructive mode and focused on testing that 135 extension. Only back below 123.60, the low that we had seen back on the 10th of April, would delay the newly adopted constructive outlook for sterling dollar. Dollar yen. So dollar yen has mostly been confined to a choppy consolidation over the past several sessions, though while the market has stalled out and rolled back over, stalled out ahead of 115 and rolled back over, the pressure does remain on the downside, and there is the possibility for a retest of the 2017 low just ahead of 108. At this point, it would take a break back above the recent high that we saw at 114.37 to negate the current bearish outlook. Euro Swiss. So Euro Swiss has rallied up in 2017, but the market hasn't been able to establish above a major psychological barrier at 110, with the rally stalling out ahead and rolling back over. But we would need to see the market now close back below some recent support around the 108.65 area to put the pressure back on the downside and expose a drop down towards the 106 area, while at the same time a break above 110 would force a meaningful shift in this structure and open the door for fresh upside in the months ahead. Aussie dollar. So Aussie, as you can see here, clearly is showing signs of topping out after the market put in a high in 2017 at 77.50, and a fresh lower top is now sought out below the previous lower top at 76.11 in favor of a continuation of declines down towards the December 2016 base at 71.60. It would take a break back below the 73.30 area to confirm a lower top that's in place just over 75 and accelerate those declines. But ultimately, even if we do see the market trade back up, while it holds below 76.11, there is risk for topside failures and for the market to continue lower. Only above 76.11, that's the high that we saw back on the 17th of April, would negate the bearish outlook. Dollar CAD. So dollar CAD has been a market that's been trending higher over the past several months, and despite this latest setback, the market is still seen as very constructive, with a higher low now sought out somewhere above the previous higher low at 32.20 in favor of that next major upside extension to retest and break above the 2017 high at 137.94. And so with the market bouncing over the past few sessions, that next higher low could now be in place around the 133.90 area, but again, that will only be confirmed if the market can establish a break above 137.94, which would then open a fresh upside extension up towards and above the 140 psychological barrier. Kiwi dollar. So the New Zealand dollar has stalled out even though it's broken above some key previous resistance at 70.90, the market has been unable to establish a close above that level, and while it holds below that level on a close basis, there is risk that we continue to stall out up here and roll back over towards a retest of the 2017 low at 68.18. If, however, the market does establish a daily close above 71, that would take the immediate pressure off the downside, but it wouldn't mean that the market is quite bullish. It just would take the immediate pressure off the downside and open the door for a bit more of a run higher, possibly up towards the 72 to 73 area. Ultimately, with this market, we'd need to see a break back above the 2017 high at 73.76. That's the high that we saw all the way back in February to really force a shift in the structure. Until then, rallies are expected to be very well capped. SPX 500. The S&P 500 continues with its record run, which isn't surprising following the breakout that we saw several days back above 2400. The break above 2400 had ended a period of consolidation between 2400 and 2320. That's an 80-point consolidation, and so the breakout above 2400 projects an 80-point move to the top side, which takes us up towards 2480 potentially. At this point, it would take a break all the way back down below 2320 now to force a meaningful shift in the structure. On a very short-term basis, the market would need to break back below 2400 to take the immediate pressure off the top side. Gold. So gold has been very constructive over the past several months, with the market putting in higher lows and higher highs. Most recently, setbacks stalled out in the 1215 area, and this area here, this 1215 area, would be confirmed as a fresh higher low if the market breaks back above the 2017 high at 1296. A break above 1296 will also open a fresh measured move extension to test the 2016 peak at 1375 further up. If we do see any setbacks over the coming sessions, they should be very well supported, with only a break back below 1215 to delay the constructive outlook for gold.